You know what's fascinating? While everyone's been obsessing over Bitcoin and tech stocks, something extraordinary has been happening in the gold market that almost nobody's talking about. And I'm not exaggerating when I say this could be the biggest wealth transfer opportunity we've seen in decades. Let me paint you a picture of what's really going on right now. Central banks around the world just bought 634 tons of gold in the first 3 quarters of this year. Now you might be thinking, okay, so what? They always buy gold. But here's what makes this different. These aren't your typical purchases. These are panic purchases. And when I show you who's buying and why, you're going to understand why keeping your wealth in cash might be the most dangerous financial decision you could make right now. Goldman Sachs just came out with a forecast that has the entire financial world buzzing. They're predicting gold will hit $4,900 per ounce. Not in 10 years. Not in 5 years. By the end of next year. Think about that for a second. Gold is trading around $4,000 right now, which means they're calling for another 22% gain on top of the massive rally we've already seen. But here's what really keeps me up at night, and what should concern you too. This isn't just about making money on gold. This is about what's happening to your cash while you're holding it. Let me tell you a story that perfectly illustrates what I'm talking about. There's a guy I know, let's call him Robert. Successful business owner, worked his entire life, built up about $800,000 in savings. Real salt-of-the-earth type. Believed in doing things the right way, saving money, being responsible. He kept everything in cash and bonds because that's what his father did, and his grandfather before him. I ran into Robert at a coffee shop a few months ago, and he looked defeated. Absolutely defeated. He told me that even though his account balance looked the same, he could feel his purchasing power evaporating. His grocery bill had doubled. His insurance premiums were through the roof. That $800,000 that felt like security 5 years ago, it now felt like it had the purchasing power of maybe $500,000, maybe less. And here's the kicker. He said to me, I did everything right. I saved. I was responsible. And I'm being punished for it. That conversation haunts me because Robert represents millions of people right now who are watching their life savings get quietly destroyed by inflation while they sleep. Now, let me show you what's really happening in the gold market, because this is where it gets interesting. You've got central banks buying gold at a pace we haven't seen since the 1970s. But it's not just that they're buying, it's who's buying and why they're buying that tells you everything you need to know about where this is headed. China's central bank has been on an absolute buying spree. They're not even trying to hide it anymore. They're openly accumulating gold because they understand something that most Western investors haven't figured out yet. The dollar's dominance as the world's reserve currency is being challenged in real time, and gold is the ultimate insurance policy. Think about what China's doing strategically. They're the world's largest gold producer. They mine about 370 tons of gold every single year. And you know what? Not 1 ounce of that gold leaves China. Not one. They keep every single ounce they produce, and then they go out into the international market and buy even more. Why would they do that? Because they're playing the long game. They're building a war chest of gold that will give them leverage in the new financial system that's being built right now, right under our noses. But it's not just China. Poland's central bank has been buying aggressively. India's been buying. Turkey's been buying. Even countries you wouldn't expect, smaller nations that are looking at the global financial system and saying, we need to protect ourselves. And here's what's really telling. These central banks aren't buying gold to make a profit. They're buying gold because they've lost faith in the current system. They're buying gold because they know something that the average person doesn't know yet. Let me break down what's actually driving this, because there are multiple forces converging all at once, and when you see them all together, it becomes crystal clear why gold is about to explode higher. First, you've got the de-dollarization trend. This is huge, and it's accelerating faster than anyone predicted. Countries around the world are actively working to reduce their dependence on the US dollar. They're setting up alternative payment systems. They're trading in their own currencies. They're using gold as a neutral settlement asset. The BRICS nations, that's Brazil, Russia, India, China, and South Africa, plus about 40 other countries that want to join, they're building an entirely new financial architecture. And at the center of that architecture, gold, not the dollar, gold. Now, I know what some people are thinking. This BRICS thing has been talked about for years. It's never going to happen. But here's what's different now. It's actually happening. These countries are tired of being subject to Western sanctions. They're tired of having their dollar reserves frozen or seized. They're tired of playing by rules that can change overnight. So, they're building something new. And whether you like it or not, whether you think it's going to work or not, the mere fact that they're trying is driving massive demand for gold. Second, you've got the debt situation. And I'm not just talking about government debt, although that's certainly part of it. I'm talking about the entire global debt bubble that's been building for decades. The United States alone has over $36 trillion in national debt. That number is so large it's almost meaningless to most people. But here's what makes it real. The interest payments on that debt are now over $1 trillion per year. Think about that. We're paying over $1 trillion just in interest, not paying down the debt. Just the interest. And it's not sustainable. Everyone knows it's not sustainable, but nobody wants to be the one to say it out loud because the implications are too scary. So what happens when you have unsustainable debt levels? Historically, there are only 3 ways out. You can grow your way out, which requires economic growth that exceeds your debt growth. That's not happening. You can default, which would be catastrophic. Or you can inflate your way out, which means printing money and devaluing your currency. Guess which option governments always choose? They inflate, they print, they devalue, and when they do that, gold goes up. It's not that gold becomes more valuable, it's that the currency becomes less valuable, and gold maintains its purchasing power. Let me give you a historical example that perfectly illustrates this. In 1971, President Nixon closed the gold window. He ended the convertibility of dollars into gold. At that time, gold was $35 an ounce. Over the next 9 years, as inflation ravaged the economy, gold went from $35 to $850. That's a 24-fold increase. Now, I'm not saying we're going to see a 24-fold increase from here, but I am saying that the same forces that drove gold higher in the 1970s are present today, except they're even more extreme. Third, you've got the supply and demand dynamics in the physical gold market, and this is where it gets really interesting. Gold mining production has essentially plateaued. We're not finding major new gold deposits. The easy gold has been mined. What's left is deeper, harder to extract, and more expensive to produce. Meanwhile, demand is surging from every direction. You've got central banks buying. You've got Asian retail buyers, particularly in China and India, buying physical gold at record levels. You've got institutional investors finally waking up to gold after years of ignoring it. And you've got a new generation of investors who are looking at the financial system and saying, I need something real, something tangible, something that can't be printed into existence. This creates a supply squeeze. And when you have a supply squeeze in any market, prices go up. It's basic economics. But here's where it gets even more interesting. There's a massive difference between paper gold and physical gold. Most of the gold that trades on exchanges like the COMEX is paper gold. It's contracts, derivatives, claims on gold that may or may not actually exist in physical form. The ratio of paper gold to physical gold is estimated to be somewhere between 100 to 1 and 250 to 1. That means for every ounce of physical gold that actually exists, there are 100 to 250 paper claims on that gold. Now, as long as everyone's happy trading paper, that system works fine. But what happens when people start demanding physical delivery? What happens when investors say, I don't want a contract, I want the actual metal? That's when the system breaks. And we're starting to see signs of stress in that system right now. Quick aside here, because this is relevant to a lot of people watching. If you're sitting on a significant amount in retirement accounts, $100,000 or more, there's actually a way to get physical gold into those accounts without triggering taxes or penalties. It's called a gold IRA, and I put together a free guide that explains exactly how it works. It's in the description below. Covers the whole process, the rules, what you need to know. Worth checking out if that applies to your situation. Anyway, back to what's happening in the market right now. You've also got the geopolitical situation, which is more unstable than it's been in decades. You've got conflicts in multiple regions. You've got tensions between major powers. You've got the threat of trade wars, actual wars, and economic warfare. And in times of geopolitical uncertainty, what do investors do? They buy gold. It's been that way for thousands of years. Gold is the ultimate safe haven asset. It doesn't have counterparty risk. It can't be hacked. It can't be frozen by a government. It's yours, and it's real. Now let me address something that I know some people are thinking. But what about Bitcoin? Isn't Bitcoin the new gold? Isn't Bitcoin the better store of value? Look, I'm not anti-Bitcoin. I think Bitcoin has a place in a diversified portfolio. But Bitcoin and gold serve different purposes. Bitcoin is a speculative technology play. It's volatile. It's still relatively new. It requires electricity and internet access to function. And it's subject to regulatory risk. Gold, on the other hand, has been money for 5,000 years. It survived every empire, every currency collapse, every financial crisis. It's the ultimate proven store of value. Can you own both? Absolutely. But don't make the mistake of thinking Bitcoin replaces gold. They're different assets with different risk profiles. Let me tell you another story that illustrates why physical gold matters. I know a family, successful professionals, who had about $2 million in various investments. Stocks, bonds, real estate, the usual stuff. They were doing well, living comfortably. Then their country went through a currency crisis. Seemingly overnight, capital controls were imposed. They couldn't access their brokerage accounts. Their bank accounts were frozen. The value of their currency was plummeting by the day. But they had made one decision years earlier that saved them. They had converted about 20% of their wealth into physical gold, which they stored securely. When everything else was locked down, they had that gold. They could sell small amounts for local currency as needed. They could use it to preserve their purchasing power while everyone else was watching their savings evaporate. That gold, which seemed like an unnecessary precaution when they bought it, became their lifeline. It gave them options when everyone else had none. Now, I'm not saying we're going to see that kind of crisis in Western countries, but I am saying that having some of your wealth in physical gold gives you insurance against scenarios that most people think could never happen. Let's talk about the technical picture in gold right now, because this is important for understanding where the price is likely headed. Gold recently broke through $4,000 per ounce, which was a major psychological and technical level. When gold breaks through major resistance levels like that, it tends to run. We saw this in 2019 when gold broke above $400. It ran all the way to $2,000. We saw it again when gold broke above $2,000. It ran to $2,800, then consolidated, and now it's broken out again. The pattern is clear. Gold moves in stages. It breaks through resistance, consolidates, then breaks through the next level. And right now we're in the early stages of what could be a massive breakout. Technical analysts are looking at gold and seeing a setup that's similar to what we saw in the late 1970s, right before gold went parabolic. You've got a long base of accumulation. You've got strong hands buying and holding. You've got weak hands being shaken out. And you've got a fundamental backdrop that's incredibly bullish. When you combine strong fundamentals with strong technicals, that's when you get explosive moves. And that's exactly what we're seeing set up in gold right now. But here's what most people don't understand about gold. Gold doesn't move in a straight line. It's not like a stock that goes up 2% a day for months. Gold consolidates for long periods, sometimes years, and then it explodes higher in short, violent moves. If you're not positioned before those moves happen, you miss them. And once they happen, it's too late to get in at good prices. Let me give you some context on what gold has done historically during periods of monetary instability. From 1971 to 1980, gold went from $35 to $850. That's a 24-fold increase over 9 years. From 2001 to 2011, gold went from $250 to $900. That's a 7.6-fold increase over 10 years. Now, we're potentially in the early stages of another major bull market in gold. It started around 2015 when gold bottomed at $1,050. It's now at $4,000. That's already a 3.8-fold increase. But if history is any guide, we could be nowhere near the top. If gold follows a similar trajectory to the 1970s bull market, we could see gold at $10,000, $15,000, maybe even higher. Now, I'm not making a prediction. I'm just showing you what's possible based on historical precedent. But here's the key point. Even if gold doesn't go to those extreme levels, even if it just goes to $5,000 or $6,000, that's still a significant gain from here. And more importantly, it's protection against the devaluation of your cash. Let's talk about what's happening with cash right now, because this is the other side of the equation that people need to understand. When you hold cash, you're holding a depreciating asset. Every year, inflation eats away at your purchasing power. The official inflation numbers might say 3% or 4%, but anyone who actually buys groceries, pays insurance, or lives in the real world knows that real inflation is much higher. Your rent or mortgage might be stable, but everything else is going up. Food is up. Energy is up. Healthcare is up. Education is up. Entertainment is up. The cost of living is rising faster than wages for most people, and it's rising much faster than the interest you're earning on your savings. So when you keep money in cash, you're losing purchasing power every single day. It's a slow, invisible tax that most people don't even realize they're paying. Gold, on the other hand, maintains its purchasing power over time. An ounce of gold today buys roughly the same amount of goods and services that an ounce of gold bought 100 years ago. The same cannot be said for any fiat currency. Think about it this way. In 1920, you could buy a nice men's suit for $20. Today, that same quality suit costs about $2,000. But an ounce of gold in 1920 was worth $20. An ounce of gold today is worth $4,000. So 1 ounce of gold in 1920 bought you one suit. 1 ounce of gold today buys you 2 suits. Gold has not only maintained its purchasing power, it's actually increased it slightly. Meanwhile, the dollar has lost over 95% of its purchasing power over that same period. This is why wealthy families, the ones who have preserved their wealth across generations, always keep a significant portion of their assets in gold. They understand that gold is not an investment. It's insurance. It's a store of value. It's a way to preserve purchasing power across time. Now let me address a common objection that people have about gold. They say, gold doesn't pay interest. It doesn't pay dividends. It just sits there. That's true. Gold doesn't generate cash flow. But here's what people miss. When you factor in the loss of purchasing power from holding cash, gold doesn't need to pay interest to be a better store of value. Let's say you have $100,000 in cash earning 4% interest in a savings account. That's $4,000 per year. But if real inflation is 8%, you're losing 4% of your purchasing power every year. So your $100,000 is really only worth $96,000 in terms of what it can buy. Now let's say you have $100,000 in gold. It doesn't pay interest, but if gold goes up 10% in a year, which is less than it's done recently, your $100,000 is now worth $110,000, and you've preserved your purchasing power. Which would you rather have? $104,000 in cash that's lost purchasing power? Or $110,000 in gold that's maintained or increased purchasing power? The answer becomes obvious when you frame it that way. Here's another thing that's happening right now that most people aren't paying attention to. The gold ETFs, the exchange-traded funds that hold physical gold, are starting to see inflows again after years of outflows. This is significant because it represents institutional money coming back into gold. For years, institutions were selling gold and buying stocks and bonds, but now they're reversing course. They're looking at the macro environment, they're looking at the risks, and they're saying, we need gold exposure. When institutional money flows into gold, it creates sustained buying pressure that drives prices higher. And we're just at the beginning of that trend. You've also got a generational shift happening. Younger investors, millennials and Gen Z, are more skeptical of the traditional financial system than previous generations. They've seen the 2008 financial crisis. They've seen the money printing during the pandemic. They've seen inflation erode their purchasing power. And they're looking for alternatives. Some are buying Bitcoin. Some are buying gold. But they're not just blindly trusting the system the way previous generations did. This creates a new source of demand for gold that didn't exist before. And as this generation accumulates wealth over the coming decades, that demand is only going to increase. Let me paint a picture of what could happen if we see a real crisis in the financial system. I'm not predicting this will happen, but it's important to understand the scenario. Let's say there's a major bank failure, or a sovereign debt crisis, or a currency crisis in a major economy. Confidence in the financial system evaporates overnight. People rush to get their money out of banks. They want something tangible, something real. What do they buy? Gold. And when everyone tries to buy gold at the same time, what happens to the price? It explodes higher. We saw a taste of this during the pandemic. When everything shut down and governments started printing trillions of dollars, gold went from $1,500 to $2,000 in a matter of months. And that wasn't even a real crisis. That was just uncertainty and money printing. Imagine what happens in a real crisis. Gold could go to $5,000, $7,000, $10,000 or higher in a very short period of time. And if you're not positioned before that happens, you'll be trying to buy gold at the top along with everyone else. This is why smart money is accumulating gold now, while it's still relatively calm. They're not waiting for the crisis to happen. They're preparing for it in advance. Now, I want to be clear about something. I'm not saying you should put all your money into gold. That would be foolish. Gold should be part of a diversified portfolio. Most experts recommend anywhere from 5% to 20% of your portfolio in gold, depending on your risk tolerance and financial situation. But I am saying that if you have zero exposure to gold right now, you're taking on more risk than you probably realize. You're betting that the current financial system will continue to function smoothly, that inflation will remain under control, that governments will manage their debt responsibly, and that there won't be any major geopolitical disruptions. That's a lot of assumptions. And if any one of those assumptions proves wrong, you're going to wish you had some gold. Let me tell you one more story, and this one really drives the point home. There was a man in Venezuela, a doctor, who had saved his entire life. He had the equivalent of about $500,000 in the local currency, which was a fortune in Venezuela. He was set for retirement. He was going to live comfortably for the rest of his life. Then hyperinflation hit. Within 2 years, his $500,000 was worthless. Literally worthless. He couldn't buy a loaf of bread with it. His entire life savings, gone. But there were people in Venezuela who had converted some of their wealth into gold years earlier. They were able to preserve their purchasing power. They were able to survive the crisis. They had options. The doctor didn't have options. He lost everything because he kept his wealth in currency, and that currency was destroyed. Now, you might be thinking, that could never happen here. We're not Venezuela. And you're probably right. The United States is not going to experience Venezuelan-style hyperinflation. But you don't need hyperinflation to lose significant purchasing power. You just need persistent inflation over time. And that's exactly what we're experiencing right now. The Federal Reserve has a stated goal of 2% inflation. That means they want your money to lose 2% of its purchasing power every year. That's their target. And they're consistently overshooting that target. At 2% inflation, your money loses half its purchasing power every 35 years. At 4% inflation, it's every 18 years. At 8% inflation, it's every 9 years. Think about that. If you're 40 years old and you have $500,000 saved for retirement, and inflation averages 4% over the next 25 years, by the time you're 65, that $500,000 will have the purchasing power of about $185,000 in today's dollars. You didn't spend it. You didn't lose it in the stock market. It just evaporated through inflation. Gold protects against that. It's not perfect. It's volatile in the short term. But over long periods of time, it maintains purchasing power in a way that cash simply cannot. Here's what I think is going to happen over the next few years, and this is based on everything we've discussed. I think gold is going to continue its march higher. We might see pullbacks along the way. We might see consolidation periods. But the overall trend is up. I think we're going to see gold at $5,000 within the next year or two. I think we could see $7,000 within 5 years. And I wouldn't be surprised to see $10,000 or higher within the next decade. But more importantly than the price of gold going up, I think we're going to see the purchasing power of cash continue to decline. And that's really what this is about. It's not about making money on gold. It's about not losing money by holding cash. The wealthy understand this. They've always understood this. That's why they keep a significant portion of their wealth in hard assets like gold, real estate, and businesses. They don't keep everything in cash because they know cash is a depreciating asset. But for some reason, average people have been conditioned to think that keeping money in the bank is safe. It's not safe. It's guaranteed to lose value over time. The only question is, how fast? So what should you do? First, educate yourself. Understand what's happening in the monetary system. Understand the forces that are driving gold higher. Don't just take my word for it. Do your own research. Second, consider allocating a portion of your portfolio to gold. Start small if you need to. Even 5% or 10% is better than nothing. You can buy physical gold coins or bars. You can buy gold ETFs. You can look into gold IRAs if you have retirement accounts. Third, think long-term. Gold is not a get-rich-quick scheme. It's a long-term store of value. Don't try to trade it. Don't try to time the market. Just accumulate it over time and hold it. And fourth, don't wait. The time to buy insurance is before you need it, not after. The time to protect your wealth is now, while things are still relatively stable, not during a crisis when everyone else is panicking. Look, I know this is a lot to take in. I know it challenges some deeply held beliefs about money and saving. But the world is changing. The financial system is changing, and if you don't adapt, you're going to be left behind. The central banks know this. That's why they're buying gold at record levels. The wealthy know this. That's why they've always kept gold as part of their portfolios. And now you know this too. The question is, what are you going to do about it? Are you going to keep all your wealth in cash and hope for the best? Or are you going to take action to protect yourself? The choice is yours. But I'll tell you this. Years from now, you're either going to look back and be glad you took action, or you're going to regret that you didn't. There's no middle ground here. The signs are all there. The central banks are buying. The fundamentals are bullish. The technicals are bullish. The macro environment is perfect for gold. Everything is lining up. This is not financial advice. I'm not telling you what to do with your money, but I am telling you to pay attention. I'm telling you to think critically about where you're keeping your wealth, and I'm telling you that the old rules don't apply anymore.